Hi everyone, happy Friday Money Wind Up. Today we're going to talk about why being good with money doesn't guarantee a home loan approval. Here's something that surprises a lot of people. You can be great with money, never miss a bill, save regularly, avoid credit card debt, and still get declined for a home loan. Sounds unfair, right? But being financially responsible and meeting a bank's lending criteria are actually two different things. Let's say you've spent years doing all the right things. You built up savings, you pay your bills on time, you don't live beyond your means, and you've worked hard to get yourself into a position where buying a home feels achievable. Naturally, you'd think this makes you an ideal borrower. But banks don't assess loans based on whether you're good with money in the everyday sense. They assess risk, and that means they look at a lot more than just your financial habits. So, for example, with your income, you could have excellent money management skills, but if your income doesn't fit a lender's policy, it can become an issue. Maybe you're self-employed and haven't been trading long enough. Maybe a large portion of your income comes from overtime or bonuses, commissions or casual work. Even though the money is real and consistent, some lenders may not count all of it, or they'll shave it off by 10 or 20%. Another example is your expenses. This is a big one. You might feel like you're managing your money well, but lenders use their own benchmarks and calculations. So even if you're comfortable with your budget, the bank may assess your expenses differently when determining your borrowing capacity. They have what they call a household expenditure measure, and they will assume that a couple with 2 kids, for example, on 100 grand or 150 grand income per year will have different expenses to somebody that has an income of 80 grand a year. The third thing that you've got to look at is your existing commitments. Things like personal loans, car finance, buy now, pay later accounts, credit cards, or even a HEX debt. You may never miss a payment, but lenders still factor those commitments into their assessment. With buy now, pay later accounts, they assume that if you do that now, even if you pay it out, unless you close the account, they assume that you will do that all the time. So it becomes a 30-year commitment, not a 3-month commitment. Sometimes it's not about whether you can manage them, it's about how they affect your servicing calculations. So this is why I often tell clients, don't assume that because you're financially responsible, that approval is automatic. Good money habits absolutely help, and they're important. But lender policies, income assessment, servicing calculations, credit history, employment type, and even the lender you choose all play a role. The good news? If one lender says no, it doesn't always mean the deal is dead. That's why getting the right advice before you apply can save a lot of frustration. If you're wondering where you stand, reach out. Let's have a conversation before you submit an application. Remember, being good with money is important, but understanding lender policy is just as important, if not more so. Happy Friday Money Wind Up, guys.